Welcome everyone. If you've ever looked at a massive industrial job site and thought, how in the world do they actually pay for all that iron? Well, you are absolutely in the right place. Today, we're mapping out the entire life cycle of heavy equipment acquisition. We're literally traveling from the dirt and grease of the construction site all the way to the highly regulated suit and tie world of the financial ledger. Let's just dive right in. Seriously, how do you pay for a 20 million rupee boom lift? It's a staggering amount of money. We constantly look at these massive skyscrapers going up and marvel at the engineering, right? But honestly, the hidden marvel is the capital required just to get the machines on the site in the first place. In the construction and industrial sectors, acquiring even a single piece of heavy machinery creates a massive, immediate cash flow problem for a business. So here is our roadmap for this explainer. 1. Choosing the right equipment. 2. Rent, lease, or buy. 3. Financing and cash flow. 4. The lease accounting rules. And 5. Right-of-use assets. We're going to explicitly bridge the gap between blue-collar logistics and white-collar accounting. All right, moving into section 1, choosing the right equipment, the grounds level. Before we even think about talking money, we absolutely have to define the physical need on the job site. Pulling some specs from Yancey Brothers, let's compare two really common machines. On the left, you've got articulating lifts. These have multiple pivot points, reaching anywhere from 30 to 80 feet. They're perfect for navigating up and over obstacles in super confined spaces. Now, on the right, we have straight boom lifts, or telescopic lifts. These are all about maximum height and brute power, reaching up to 135 feet with a 750-pound platform capacity. You simply can't make a financial decision until you know exactly what terrain and reach your project demands. Simply put, the dirt dictates the dollars. Which brings us to section 2, rent, lease, or buy, the acquisition strategy. So once you know you absolutely need that massive 135-foot straight boom lift, how do you actually get it without totally destroying your working capital? Well, that brings us right back to this totally staggering number, 20 million Indian rupees. According to the Moritan Group, that's the upper end of the price tag for buying a new boom lift outright. If a small or mid-sized contractor drops that kind of cash up front, it immediately and heavily strains their cash flow. I mean, it ties up crucial capital that could be used for payroll, marketing, or, emergency expenses. The real trick is figuring out when to avoid that massive purchase. There are 5 distinct benefits to renting, especially if we're talking about short-term projects. First off, it preserves cash flow. You're just paying a fraction of the cost per day or week. Second, it totally eliminates storage and transport costs because the rental company handles all those logistics. Third, maintenance and repairs are usually included. That removes a huge operational headache right there. Fourth, you get access to the absolute latest technology, like eco-friendly electric lifts, without being stuck with outdated tech 5 years down the line. And fifth, it offers ultimate flexibility. If you need a straight boom today and an articulating boom next week, renting makes that swap a breeze. Moving right along to section 3, financing and cash flow, the long-term play. Now, what if you're not just doing a quick short-term project? If you need a machine long-term, year-round, you're generally looking at a showdown between leasing and financing. Leasing typically gives you lower monthly payments and really protects you against obsolescence. You can just trade the machine in for a newer model when the lease is up. It's incredibly flexible. Financing, or taking out a traditional equipment loan, is a completely different game. That's about building permanent equity. You get outright ownership of the asset and benefit from fixed interest rates, which makes long-term budgeting super predictable. And look, we absolutely cannot ignore the tax implications here. Whether you finance or buy outright, in many jurisdictions, there are some very powerful tax strategies at play. For example, in the U.S., qualified purchases can often be fully deducted under IRS Section 179 or through 100% bonus depreciation. That literally means you could potentially write off the entire purchase price in year 1. Deducting the cost of that massive machine from your taxable income is just a highly effective way to drastically preserve your working capital, all while still owning the asset outright. Let's transition to section 4, the lease accounting rules, the boardroom reality. Okay, we are officially leaving the physical construction yard behind and stepping into the boardroom to navigate ASC 842. How do you actually know if your lease is standard or if it's a heavily regulated finance lease? Well, you run these 5 bright line tests. Number 1, does ownership transfer at the end? 2, is there a purchase option you're reasonably certain to use? 3, does the lease cover 75% or more of the asset's economic life? 4, does the present value of your payments equal 90% or more of the asset's fair value? And 5, Is the asset so highly specialized that it has no alternative use for the lessor later on? If your lease meets even one of these criteria, boom, it is classified as a finance lease on your books. So why does that classification even matter? Well, as the accounting firm Whipley puts it, and this is a great quote, under the new standard, lessees will have to recognize nearly all leases on the balance sheet. This is a monumental shift. It effectively ends the entire era of hidden off-balance sheet financing. Before this rule, companies could lease massive fleets of equipment and keep that debt totally hidden off their balance sheet. Well, not anymore. This change swells the balance sheet and directly impacts your loan covenants, your working capital calculations, and your debt ratios. Believe me, lenders are watching this very closely. Which leads us nicely into Section 5, right-of-use assets, bridging the gap. So here's the million-dollar question. How do accountants actually put a lease on the balance sheet if you don't legally own the machine? They do it through a right-of-use, or ROU, asset. This basically represents your contractual right to control and use an identified asset. Think about it like this. You don't own the physical 80 tons of steel that makes up the boom lift. But by signing that lease, you do own the financial right to use it for the next 5 years. And that financial right holds a very real, tangible value that absolutely has to be recorded as an asset, paired directly with the liability of your future lease payments. So how do we actually calculate the value of this newly minted ROU asset? Based on guidance from Sterling, it's a pretty logical 4-step formula. Step 1, determine the initial lease liability, which is just the present value of all your future payments. Step 2, add any prepaid rent and initial direct costs, things like legal fees or commissions. Step 3, add any restoration obligations. Basically, what's it going to cost to return the asset to its original state? And finally, step 4, subtract any lease incentives you might have received from the lessor. Do that math, and you've got the starting value of your ROU asset for the balance sheet. Now, global accounting standards actually diverge a bit on what happens to that ROU asset over time. Under the U.S. standard, ASC 842, there's a dual model. Operating leases have a straight-line expense on the income statement, which keeps costs nice and flat, while finance leases have front-loaded expenses. On the flip side, the international standard, IFRS 16, uses a single model. Under IFRS, virtually all leases are treated like finance leases. That means the expenses are front-loaded, hitting your income statement much harder in the early years of the lease. Now, if calculating ROU assets sounds like an absolute nightmare for a quick one-off project, here is your strategic sigh of relief: crucial accounting exemptions. If you have a short-term lease, meaning a contract under 12 months, you generally don't even have to put it on the balance sheet. And under the international IFRS 16 standard, there's also an exemption for low-value assets under $5,000. This perfectly ties back to our physical job site strategy. Renting heavy machinery for short-term projects keeps your balance sheet squeaky clean and helps you dodge a massive accounting burden. As we wrap up, I want to leave you with this final, somewhat provocative question. Is your current fleet management strategy balancing operational efficiency out on the job site with total financial transparency on the balance sheet? As we've seen today, you really can't make equipment decisions in a vacuum. A great deal in a heavy machinery lease in the dirt might accidentally blow up your debt ratios in the boardroom. If you evaluate your strategy from both the physical logistics and the accounting ledger, you're going to be building your business on a truly solid foundation. Thanks so much for joining me on this explainer, and as always, keep learning.